The alert came quietly, but the shockwaves were instant. A U.S. cargo ship packed with soybeans was sailing across the Pacific when trading terminals in Singapore lit up. China cancels all U.S. soybean shipments, effective immediately. By midday, 2.4 million tons were rerouted to Brazil. By nightfall, $1.1 billion in American farm exports had vanished. This wasn't a trade war. It was a controlled demolition, and soybeans were the fuse. More than 40 ships were redirected. A multi-billion-dollar supply chain snapped like a dry twig. This wasn't a glitch in global trade. It was a deliberate signal. And it wasn't just farmers who paid attention. Wall Street noticed. The Pentagon noticed. When your largest buyer halts shipments without blinking, it's not negotiation, it's a stress test. And America failed it first. Bloomberg broke the story. China had suddenly pulled orders from three of the biggest U.S. exporters, Cargill, ADM, and Bunge, citing a strategic procurement shift. Within days, Chinese firms replaced the supply, buying 2.4 million metric tons of Brazilian soybeans, valued at over $1.1 billion, according to S&P Global and Chinese customs data. That single purchase covered nearly one-third of China's usual monthly soybean imports. Officially, Beijing didn't call it retaliation, but the move came less than 48 hours after President Trump announced new tariffs, $90 billion worth of Chinese goods hit with duties. Analysts at Rabobank warned, this isn't a one-time warning, it's a shift. A deliberate effort to end U.S. dominance in global agriculture. Back home, the effects were immediate. According to the USDA's April 2025 report, unsold soybean inventories jumped 13%, hitting their highest April level since 2019. Prices on the Chicago Board of Trade dropped 8.2%, wiping out over $470 million in just 1 week. In Iowa, farmer sentiment collapsed. "We got cut off mid-season with no plan B," said Matt Dunn, a fourth-generation farmer in Des Moines, in an interview with the Wall Street Journal. "This isn't a trade dispute anymore, it's economic isolation." The American Soybean Association now warns that this Chinese pullout could slash farm income by up to 18% in just 1 quarter. So what's really going on? President Trump's 20% tariff on Chinese electronics, metals, and EV parts, announced on March 10th, was supposed to pressure Beijing ahead of talks. Instead, China hit back with surgical precision, targeting one of the last major U.S. exports it still relied on, agriculture. And soybeans weren't just any crop. In 2024, the U.S. exported $14.3 billion worth of soybeans to China, making it the biggest single export in the entire U.S.-China trade relationship. China is going after Trump's political base, rural America and the farm states, said Chad Bown, senior fellow at the Peterson Institute, in an April 2nd interview with CNBC. On that same day, the USDA confirmed that farmers across 11 Midwestern states now face moderate to high risk of insolvency due to canceled forward contracts. So now the question shifts. Is this trade war becoming a political crisis at home for Trump? Let's pause, not because the story's slowed down, but because it's taken a new shape. This isn't just about soybeans anymore, it's about long-term strategy. Brazil's readiness wasn't luck, it was carefully planned. Between 2020 and 2024, Brazil expanded its soybean acreage by 21%, backed by over $11.2 billion in infrastructure investments. China helped fund it. State-run banks financed grain terminals in Santos, upgraded freight routes from Mato Grosso, and co-financed the Ferrogrão Railway, cutting internal shipping times by 42%, according to a February 2025 Reuters report. This infrastructure laid the groundwork for China's pivot. Now, Bloomberg Intelligence estimates Brazil could meet up to 70% of China's soybean demand, especially with fewer GMO restrictions, looser environmental rules, and stronger BRICS trade protections. Brazil's rise isn't temporary, it could be permanent. So is the U.S. being pushed out, not just underpriced but outplanned? The timing says it all. Between March and June, United States soybean exports reached their peak value, generating up to 40% of annual farm export revenue, according to USDA data. By cutting imports during this critical window, China caused a market collapse just when U.S. exporters needed sales the most. Meanwhile, Brazil's harvest wasn't even complete, and yet China still paid a premium to make the switch. According to Financial Times interviews with global traders, China paid $14 to $22 more per ton to secure Brazilian soybeans. So the real question is, why would China willingly overpay? According to Minyu, a trade expert at China's Ministry of Commerce, short-term economic losses can sometimes be the price of long-term control. In that sense, this wasn't just about soybeans. It was about power and influence. China claimed the suspension was due to phytosanitary concerns, citing issues like fungal residue and pesticide traces in U.S. soybean shipments. But as of April 2025, no such violations had been confirmed by the USDA or registered in the WTO's complaint system. U.S. soybeans consistently meet international food safety standards. A joint audit by the FDA and GAFTA found contamination levels below 0.01%. Still, many trade experts remain skeptical. As Andrew Tilton, Goldman Sachs' chief Asia economist, put it, there's almost no precedent for banning imports over safety without prior inspections or official warnings. By using these types of regulatory blocks instead of formal tariffs, China avoids direct challenges at the WTO, while also signaling unpredictability to American exporters. So what's really going on? Is this genuinely about food safety, or is it economic retaliation disguised as regulation? Let's take a closer look at how China is turning soybeans into a tool of global influence. Not just at trade talks, but through ports, railroads, and billion-dollar infrastructure projects. China's shift away from U.S. soybeans didn't begin with negotiation tables. It began with logistics. Over the past 5 years, China has poured more than $8.3 billion into transport infrastructure across Latin America, according to the Inter-American Dialogue. This includes a major stake in Brazil's Port of Itaqui, a $1.22 billion upgrade to the Northern Grain Corridor, and direct funding for the Ferrovia Norte-Sul Railway, cutting transport costs from the grain belt of Mato Grosso by 35%. These aren't just trade routes, they're strategic lifelines. By embedding itself in the physical infrastructure that moves Brazilian soybeans, China isn't just replacing U.S. suppliers. It's also bypassing global shipping choke points that Washington often influences. In 2024, over 64% of China's soybean imports came through supply chains where Chinese companies had direct involvement, according to Bloomberg's review of customs data. As one analyst from the Carnegie Endowment noted, China's not just buying food anymore, it's buying leverage. And here's the part that's really worrying U.S. policymakers. What if soybeans were only the beginning? While soybeans grab the headlines, U.S. corn is quietly being phased out. Between January and March 2025, American corn shipments to China fell by 29% compared to the same period last year, according to the USDA. During that same stretch, China signed a 3-year deal with Brazil's COAB agency to import up to 9 million tons of corn annually, a deal worth around $2.66 billion, according to a March 28 Reuters report. Also in March, China's state grain reserves sold off 1.2 million tons of U.S. corn. Officially, they cited price instability and the need for strategic rebalancing. But insiders say the deeper issue is trust. After years of tariffs, export bans, and political uncertainty, Beijing increasingly sees U.S. agriculture as a liability. This isn't just diversification, it's insulation, said Joseph Glauber, former chief economist at the USDA, in an interview with the Wall Street Journal. And that raises another question. If corn's on its way out, what's next? Wheat? Sorghum? What we're seeing is more than just a temporary shift. It's structural, and U.S. markets may only now be starting to feel the impact. While U.S. officials insist the door to negotiation is still open, China's recent moves suggest otherwise. According to HSBC's April 2025 commodities report, China has now signed or extended long-term import agreements with Argentina, Brazil, Russia, and Pakistan, countries that together now meet over 70% of China's grain and oilseed needs. Meanwhile, American farm exports to China have dropped 26% in just the first quarter of 2025, cutting $3.2 billion from bilateral trade, according to Census Bureau data. Some experts believe better diplomacy could improve things. But even if tariffs disappeared tomorrow, China now has the logistics, suppliers, and motivation to move on. This isn't just about reducing risk anymore. It's about cutting ties, said Jennifer Harris, a former advisor to the U.S. National Security Council, in a recent interview with Bloomberg. With tensions between Washington and Beijing rising, and the BRICS Plus alliance offering new trade options, the real question may no longer be, can the U.S. win China back? But does China even want to return? And that brings us to the real shock. What if soybeans were just the test run? China just showed the world that it could walk away from a $14 billion commodity in under 72 hours. Without delays, without shortages, and without public backlash. So what happens when the next walkout isn't about soybeans? What happens if China pulls the same move with semiconductors, with rare earth metals, or even with U.S. government debt? That's not just a concern for farmers. It's a warning for Wall Street and the policymakers in Washington. Because if this was only step one, what does step two look like? If soybeans were just the beginning, then the U.S. dollar could be next.